I just want to say, for those of you that have sent in some support tickets, we are aware that there is currently a data issue on OptionsPlay. We are diligently working with our data providers to resolve that. So we hope to have a resolution with them before the market opens. So I just want to let you guys know. So let's go ahead and get started. But before I do, just a quick disclaimer. What we're going to discuss here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. And just a bit of housekeeping before we go ahead and get started. Next week is a shortened week due to the holidays. So we are going to be canceling the Tuesday morning market outlook session and the Thursday afternoon education session, but we will be sending out daily emails for market observations as well as where we think the markets are currently, the morning observations as well. So those will still be going out, but I will be hosting a special session next Wednesday, just an Ask Me Anything session. You can submit questions ahead of time. You can literally ask me any type of question you want, regardless of whether it is trading related or not. We'll try to have a little bit of fun on that type of session. You can certainly ask me trading questions if you'd like, but you can also ask me anything else. So really looking forward to that. But just a bit of housekeeping, we won't be doing the Tuesday morning, certainly won't be doing the Friday morning because that's when the markets are closed. And we will not be doing a Thursday afternoon education session because it's right before the holidays. And I would imagine most people are going to be trying to get away. So today we're going to be talking a little bit about the consolidation. It continues. A lot of questions regarding whether it's time to see that the markets are going to start correcting or not. But at the moment, everything still shows us that the market is relatively healthy. I'm going to show you some of the data that we're looking at to suggest that. And then what we want to actually take a bit of time looking at is some of the updates to the economic stuff that we have looked at over the past few weeks. Everything due with COVID-19 numbers, everything with consumer spending, as well as real-time economics that give us a better understanding as to how the economy is actually doing. A lot of questions and concerns about whether or not the equity markets have decoupled from fundamentals in reality. So we're going to actually explore some of that and see where reality actually is to help answer that question. And then what we're going to do is we're going to go through all the sectors. I want to do another sector review, see where all the sectors are, because sector rotation still seems to be, we're still seeing a fair amount of healthy sector rotation, a little less of it now. So, when we're trying to answer whether or not we think this market is healthy or not, or this rally is healthy, we usually want to see strong sector rotation in order for us to say that. So I want to review the sectors and see where they currently stand. So let's go ahead and get started. Now, what we're going to first start off with is looking at the Qs, the NASDAQ 100 index. And the reason I want to bring this up is because the NASDAQ 100 index has really been the index that have been leading this market. So if you're looking for performance, this is the index to be paying attention to. Now, one of the things that we pointed out on Tuesday was the fact that when we looked at the sector rotation, when we're looking at the chart of the NASDAQ 100 index, what we saw is that on the daily chart, we saw some negative divergence. Now, that negative divergence has resolved itself by pulling back to that 20-day moving average on the daily chart. But the one thing that we do want to still point out is that you have this massive negative divergence on the weekly chart. That has not resolved itself yet. So what you have is short-term, a bit of a pullback, but long-term, you still have this higher probability of this pullback here in NASDAQ 100. So if you're thinking about the tech, and that's predominantly the technology and the biotech indices. Now, one of the things that I want to, again, reiterate for this is the fact that an index like this or a market like this can remain overbought and in negative divergence for quite some time before it actually resolves itself. So especially when you're talking about a weekly chart, this could be 3, 4, 5, 6 weeks before that negative divergence necessarily resolves itself, meaning pulls back. So just because we see negative divergence is not a good reason to outright go out there and short. We certainly had a bit of a short-term pullback here on the daily charts, but keep in mind that what we notice out of this negative divergence is simply just a higher probability of pullback, and that if the negative divergence happens for a longer period of time, that usually resolves itself in more violent and more fast pullbacks. But the negative divergence in itself is not a good reason to outright go and short it. But when you do see that opportunity to short, those opportunities tend to be quick and fast, especially on the weekly chart. So that's what we're currently looking at in terms of the, whoops, that's currently what we're looking at in terms of the NASDAQ 100 index. Now let's take a look at the S&P 500 index. Just want to make sure everyone can see my screen here, right? With S&P 500 on the screen. Just want to make sure if you can please type yes into the chat window. Okay, perfect. So the S&P 500, we've been talking about this for a while, where the S&P 500 is really at this point consolidating for quite a bit. And we have this triangle here that's been forming here for the past couple of weeks. And momentum has really shifted here. You know, we had very strong upward momentum here in the S&P 500, but over the past couple of weeks, that momentum has started to slow down. This, we know, is due to the rise in COVID-19 cases across the United States. At first, it was just 4 or 5 states. Now it's accelerated out to closer to 20, 25 states that are starting to see an increase in terms of number of cases. And this is what's caused a pause in this particular rally. Now, one of the questions that we've been getting a lot is whether or not the markets are going to start reversing lower. So from our perspective, markets are still above this 300, 302 level. This is a key level that we've been talking about for weeks, at least in the recent past. And then also we talked about this level back here in July and September of last year. So this is a very important level to keep an eye out for. As long as we stay above that level, and as of today's open, we're looking like it's still going to open around flat. We're still in our more neutral view here in the markets rather than bearish until the markets break below this key support level. At the moment, we don't have an indication that it's going to break below that level just yet, but it's something that things change very quickly in this current market that we're trading. So keep an eye out for 302, 300 as a major support level for the S&P 500 to hold. At this point, we don't have a strong bullish case here for the markets, so we're not necessarily seeking some buying call spreads here, because we do think that the upside here in this particular market is fairly limited, at least until we see the COVID-19 cases see some declines in terms of those cases. And right now, unfortunately, those are only rising, and the number of states that we're seeing this across is still rising, and that's a concern of ours. So one of the questions that we've been getting pretty much since the March rally is really how long can this rally last and how healthy is this rally? So most of the questions back here in April and May were, is this a bear market rally? And especially when you had a few different sell-offs throughout it, a lot of concern saying that, oh, now the start of the bear market is here. But that has not happened. The markets continue to march higher. You had higher highs, higher lows. We continue to put in higher highs and higher lows. Now, again, that momentum has started to slow down. And one of the things that we did say throughout this rally, at least in the past couple of months, is the fact that we felt that this market rally actually was very healthy, significantly healthier than the rally that we saw here from November to February. And the reason we said this is because during November to February, it was predominantly just the mega cap tech names that led this market higher. Pretty much all the other sectors, whether you looked at small cap, whether you looked at the individual sectors, they were not leading this market. They were actually lagging behind by a significant margin. But as the market rallied from March lows to where they are today, the small caps, the equal weight index, the different sectors, they were all participating. It wasn't just led by a few mega cap names. Actually, in the early days, in the early beginnings of this rally, the mega cap names actually lagged behind. So because of that, we were very clear on our market outlook sessions that this market rally was relatively healthy, and that's why we were confident in buying the dips, as opposed to simply saying every time the market dipped that it was about to start correcting. I will say some of the things that we pointed out here on Tuesday was that trend was starting to reverse, meaning we were starting to see equal weight, small cap start to lag behind. We started to see we didn't see the sector rotation that we were used to seeing in the current markets, and we're just not quite seeing it just yet. So there is this trend that's starting to reverse. And if you look at the mega cap names, Apple, Facebook, Amazon, Google, Microsoft, and Netflix, those stocks now make up 25% of the market cap, the S&P 500. So they are at pretty extreme values. But again, keep that in mind that just because it's at an extreme reading does not mean that the markets are going to correct. It just means that when they do correct, the probability of a quick and fast move tends to be elevated. So these are things to keep in the back of your mind, but in itself is not a good reason to go out there and short. So I know there's a lot of concerns about whether or not this market continue to hold, and I'm not necessarily suggesting that that the risks aren't skewed to the downside. I think the risks right now are definitely skewed to the downside, especially as consumer spending, as we'll take a look at in a couple of minutes, start to get back to normal. I think once we get that complacency in the market, that's really where you do have the risks of movement to the downside. So those are some of the things I want to show you here. So equal weight index, same thing. Equal weight index surprisingly really took off when the S&P 500 started to fizzle out a little bit in terms of rally, but over the past couple of weeks have started to lag behind. At least the last couple of trading sessions this week has started to lag behind. Yesterday, it was actually pretty good. It started to lead back again. So we're going to keep an eye out on this, because if equal weight and small cap can keep up with the markets over the next week, then that might put us back into a more bullish view here on the markets. But as of right now, due to the narrowing leadership that we're currently seeing, it's really predominantly tech and biotech that's leading this market rally. That type of narrowing leadership is concerning as markets continue to make new highs, okay? So volatility, also something that we want to keep an eye out, because VIX has not moved below 30. It has basically stayed range bound this whole time between 30 and 35, meaning volatility is still very elevated. That generally means that whenever you're trading these types of markets, you want to think about how you want to position yourself with respect to options. And specifically, buying calls, buying puts are going to be very, very expensive. As you can see, it's trading at roughly triple the value it was back in January or February. So buying calls and puts, they're going to be expensive. We are leaning more towards selling calls and puts, specifically credit spreads in this type of market environment, because volatility is high, but it's not choppy, because when volatility is high like this is generally not a good time to sell volatility, because it's very volatile. But when volatility is high and it's relatively stable, that is a better environment to be selling volatility. So because we don't have a strong view that markets are going to move significantly higher or significantly lower, and we think that markets are more neutral and volatility is high, this is the environment that you want to sell volatility in. Just be aware that because this type of environment may change, right? We could get a huge spike in terms of volatility, or volatility can continue to move lower. These are things that are changing very actively. So it's important that you keep an eye out for these types of indicators to give you a sense for what type of environment or what type of option strategy should we be utilizing in this type of market environment. So strategies like selling put spreads, like we just suggested here on AMD for our daily play today, those are the types of strategies that you might want to consider for the slightly bullish stocks that you're looking for, and then selling call credit spreads on the slightly bearish stocks, or the bearish leaning stocks that you may have that you're looking at, such as Hershey that we had earlier this week. So those are the types of strategies that we're utilizing to play this more neutral market right now. So with that, what I want to do is I want to point you to some of the COVID-19 trends. So a couple of weeks ago, when I brought this up on CNBC, we were seeing predominantly 4 states, Arizona, Florida, Texas, and California, that were seeing an uptick in terms of number of new cases. So as you can see here, over the past couple of weeks, what we have seen is that the number of states that have seen an increase in terms of number of states is closer to 25 states now. So this is the concerning trend. This is what's caused the pause in the rally that we're currently seeing. But there is good news on the other half, is that the other half of the states have seen improvements. Now, the question or the concern that we have is the states that are currently seeing the increase in terms of cases, what type of policies they plan on instituting. At the moment, there hasn't been any drastic movement. There hasn't been any shutdown of these states. There haven't been any major restrictions. Texas did suggest that they were going to pause their phase 3 opening. That certainly is going to hurt, but nothing of major in terms of locking down their states or anything like that just yet. But if you do see that, that is where I think markets could react negatively to that. Now, again, we haven't seen that just yet, so it's important that we keep an eye out. But the risks here are clearly skewed to the downside, because I don't see any type of it's hard to imagine that all of a sudden these states are just going to flatten the curve and things are going to be okay. Especially in some of the worst states like Arizona and Florida. So those are major economies in the United States. Arizona, Florida, Texas, and California are four out of the 5 largest economies in the United States. Versus New York is one of the few that are actually getting better. So risks are currently skewed to the downside, in my opinion, here as far as COVID-19, but the market hasn't reacted very negatively to that. So we're still keeping an eye out on this. If things improve here, markets, that I think would be a good reason for the market to start to resume its bullish trend, especially if it manages to hold that 300, 302 level on the S&P 500. So keep an eye out on this. We'll keep you updated on that as well. Another thing I wanted to update you guys is the consumer spending. We've been looking at this for quite some time. Now, the first thing I want to point you to is the fact that consumer spending, as you can see over the days, have actually started to return back to normal over the past couple of days. Now, this is compared to the same time last year, but we've seen consumer spending, credit card data return back to normal. And basically what we've seen is that all the amount of money that's being spent, it's being lost on airlines, lodging, and entertainment has been roughly offset by furniture spending, online electronics, online retail, and even grocery, general merchandise, and home improvement remains relatively strong. So when we think about consumer spending, we are clearly seeing that the shift in spending has shifted to other places. Now, I will say that one of the things that we have been paying attention to is the fact that consumer spending remains relatively strong, because you still have stimulus money flowing through the economy. You still have unemployment money that's still flowing through, and that's going to end in July. So that's coming up in about a month and a half. So this is something to keep an eye out for. But until then, we certainly see consumer spending to remain relatively strong. So some of these sectors that we're paying attention to, online electronics, this is part of the reason why we quite like AMD as a semiconductor stock, because the AMD is a big supplier of many of the online electronics that you see that you might have to buy as a result of working from home, whether that's a laptop, whether that's a webcam, or any of those types of devices. Grocery also remains relatively strong. A lot of people asking about Costco and Kroger. We talked about that on our live market analysis session yesterday, so please take a look at that if you missed that recording. And lastly, I do want to talk a little bit about real-time economics. So, a lot of questions about whether the markets have decoupled from the economics. And for the most part, one of the things that I want to point out is that the economic numbers predominantly that we look at lag by quite a bit, many times by a few weeks, sometimes by even a month or so. So we like to use more real-time economics that you can have access to more frequently, or data that you have access to more frequently. And what's concerning is that really the economic recovery is very lumpy and very choppy at best, meaning it isn't particularly strong. We certainly have a whip saw back, if you will, from the extreme negative numbers that we saw back in March and April. May certainly is improved, but going into June, going into July, are those numbers going to continue to improve at the same pace? The answer is I'm not as confident in that. So I do agree with many people who see that the economics have decoupled from the markets, and I don't disagree with you at all. The thing I just want to remind you is that just because you see a decoupling many times is not necessarily good reason to go out there and short. You want to wait until the market breaks below support, you see some acceleration in terms of volatility. That is when you want to put on a hedge or a short for your portfolio. As we've pointed out over the past few weeks, shorting this market is very difficult to do. Even if you are able to capture a short, you find that those shorts generally last only a couple of days. So you want to make sure that you are in and out relatively quickly, or if you're selling premium for a short, that you are diligent in terms of watching your levels and making sure that you are getting out at the right time. So be careful as you're shorting this particular market. I know there are a lot of opportunities that you might think that they're available, especially as the COVID-19 cases tick up, but my preference here is to be more defensive in names that might actually do well in that type of environment. Think about grocery stores, think about working from home, think about Clorox, those types of names. I'd rather be long those names so that if you do get risks to the downside, that those stocks do well, rather than trying to pick stocks that you think are going to underperform in the event of a market sell-off. So let's take a look at all of these sectors. We'll take a look at the sectors one by one. We'll take a look at materials first. Materials actually looking surprisingly strong, but at the moment it is still managing to stay above this major $54 level, which is a key level to keep an eye out on, because if it does break below 54, that would put this sector in play for a fairly large move to the downside into that $48 zone. So keep an eye here on materials. Materials on the verge, very neutral at the moment, but potentially on the verge of a breakdown here. It is stuck between the 200-week and the 20-week moving average. The 20-week moving average coming in around 53 or so. And again, a break below that brings it significantly lower down to that 48 level. So materials, not particularly strong, and certainly at risk here. Same thing with industrials. You've had this huge move to the upside, came back to retest that as support, bounced off it, and then retested support again. That's usually not a very strong indicator of a continuation higher, but that's not to say it won't happen. And if you look at the weekly chart, it is still below the 200-week moving average and is currently just flirting below the 20-week moving average. So from my perspective, you have some quick support levels here around 64, but really down to the 60 level here on XLI, the industrials here. So industrials not looking particularly strong here. Communications we've been talking about for quite some time, very, very strong. But as you can see, the momentum of that has really kind of started to move that lower. And so the momentum in this particular case has really started to move sideways. Now, I will say communications, one of the strongest sectors, starting to forming this consolidation. Now, this consolidation could very well resolve itself to the upside. It could resolve itself to the downside. We don't know just yet. We are waiting to see. This is one that I am very curious to see, because you have Netflix that's dragging this sector up. You have a lot of telecom stocks that have not been doing very well, but then you have T-Mobile that's been doing really well. So you have this kind of tension right now in this particular sector, and I'm curious to see how communications is going to resolve itself. I'm more bullish on this particular sector. You don't have the weekly, I would say, negative divergence that you saw here on technology. So I like this a lot more than the technology sector. But the two charts look very similar to each other. But I like the fundamentals here of communications a little better than some of the technology names. Real estate at the moment still looking okay, but you have this flag here, if you will, and if you, from a classic technical analysis perspective, what you basically have is a sector that was bearish, consolidated for quite some time, and may resolve itself again to the downside. So not as strong here on real estate. It does not have the strongest fundamentals. It's recently tried to break above its 20-week moving average, but is now below its 20-week moving average, and it's just testing its 200-week moving average here around 33.75. If we break below that, that's when I think you could see some big moves to the downside around 30. So as you look at all these sectors, you start to realize that there's certainly a potential for a move to the downside for the markets. And you see it in all the different sectors. And you want to pay attention to these sectors, because if you see materials, if you see industrials, if you see real estate start to break down, that is potentially the catalyst that the market needs to continue to move lower. Financials took a big move to the upside yesterday, but on after hours started to fade as some of the stress test news started to come out. And one thing I will point out, financials looking still very, very weak. You have this 23.5 level that was resistance, came back to test this as support, and is now broken below it. And we're just trading below this 23.5 level. So it's now trading at 23.17. So financials, in my opinion, is in this more bearish state. I would target this level here to the downside, 21.5 roughly to the downside here for financials. So financials, one of the weakest sectors, in my opinion, right now here in this market. Consumer discretionary, very strong, but one of the things we pointed out earlier this week was the fact that consumer discretionary had that weekly negative divergence. So resolved itself for the most part, so that's okay at the moment. You have this massive double top here, and the question is whether or not this thing can actually manage to break above that double top. You have a fairly, I would say, strong chart here, but as you can see, momentum has really started to pull back here. This is a chart that looks very similar to communications, where you have this consolidation period, and this consolidation period needs to resolve itself one way or another. And if you think about the consumer spending data that I just showed you, that has been very strong, but the question is whether or not that can last. At the moment, the consensus seems to be that, as we go post-July, as we get into the August season, that cannot last, especially if you look at the unemployment numbers that we're currently seeing. We're still getting new unemployment numbers in the 1.5 million unemployment claims, new claims every single week. And if you think about someone who's being let go today, this week, it's not necessarily due to the original shutdown of COVID. These are likely jobs that are permanently going to be lost. These are companies that probably were struggling prior to COVID-19 that COVID-19 certainly didn't help, but had stimulus money, or maybe were able to kick the can down the road a couple of months or a few months, and now are at the point where they are failing again. So we're really thinking about this as a longer term structural unemployment issue, not just a short term one, especially if you think about the number of new unemployment claims that we're still getting at this point. So this is a concern of ours for the consumer market. So we have this double top here at 132. This is of a concern to us. Let's look at staples, sorry. Staples have been extremely sideways. So not a particularly strong view here in this particular case. This is a very sideways market. Consumer staples, we think, is more of a defensive play right now in the current market environment. So as you kind of hit the bottom of that range, that might be a good buying opportunity. As you hit the top of the range, that might be a good selling opportunity. This is the sector that I think is best from a risk perspective to sell put credit spreads when you get to the bottom and sell call credit spreads when you get to the top. You don't see a strong directional view in this particular case, and with volatility relatively high yet stable, these are the types of names that you might want to sell that put spread or call credit spread. Utilities looking fairly weak here. Utilities, I'm actually a little bit surprised at how weak it is, in terms of the fact that we think of utilities usually as a little bit more defensive. It does pay quite a bit of premium in terms of yield. Yet we're seeing utilities really, it's really weak right now. It got rejected effectively at the 20-week moving average. It is now testing the 200-week moving average. If we break below that, that brings us all the way down to 50 on the XLU. And we're starting to see a little bit of a breakdown here on the daily chart. So XLU looking relatively weak. And as you can see, as I go through all of the sectors, many of the sectors, have more of a bearish view here, or risk clearly skewed to the downside, and that is the same risk that we currently see in the broader market. Healthcare has been really sideways for quite some time. It looked like it was going to break out to the upside, but it did not. It failed and came all the way down to the downside. Now we're testing support again to the downside. So again, big vacuum to the downside. If we do break below, you have some moves, big moves to the downside. So again, if we do get a breakdown, we could see some quick and violent moves to the downside. Technology just barely hanging on to that all-time high from February. So the fact that it managed to get above that level currently right now is still bullish. This is one of the few sectors that we are bullish on, but the thing that we do want to remind you here is this massive negative divergence that we're seeing here on the weekly charts. Again, that in itself, not a reason to go out and short, but be very aware that there is significantly more risk in going long technology now than some of the other sectors. Energy started to weaken a little. We talked about crude getting rejected at that $41 level earlier this week. We've been talking about that level for quite some time, and the rejection at that level has certainly put energy in a much weaker foot, and it has broken down to the downside, this bullish channel. Now, I will say that I personally don't trade a lot of energy just because I think it's more of it's very volatile. I don't particularly always have a strong view as far as where crude prices are going to go. So it's not something that I trade very heavily myself, but it is something to pay attention to. And it is one of the sectors that, as you can see, based on the chart, is starting to break down to the downside. This is going to add to this concern that the risks skew to the downside for the whole market. So when we review all the different sectors, things are very neutral at the moment, but like I said, keep an eye out for some of these key levels that are referred to. Those are the ones that you're going to pay attention to. And again, I know a lot of comments regarding there are some issues with the platform and pricing on the platform. We are aware of it. We are working with our data provider to try to resolve that as quickly as possible. Yes, we are aware of these issues. So we're doing everything we can to make sure that these are fixed right at the open. Okay, so thank you so much, everyone. I hope you guys find this useful in helping you better understand how to position for this current market. We are going into what should be a relatively quiet market next week. Now, quiet markets or thin liquidity may actually resolve in bigger moves because there's thinner liquidity. So be very diligent next week, especially if you're going away on vacation. You're not going to be staring at your screens. Keep an eye out on that. So thank you so much. I hope you guys have a great weekend, and I'll see you guys next week. Please submit your questions for the AMA. I really welcome your questions for that. I'm really looking forward to having more of a fun session with you guys. So thank you so much. Have a great weekend.